ask us, can I use my income, but then use my spouse's credit to qualify? And the simple answer to that is no, unfortunately, you can't. It would make sense that as a team, you could use one person's credit, one person's income. However, the person that has the income is really the most important person, and that's the person that we need to evaluate their ability to pay back the loan. And if the person that has the income is not the person that is creditworthy, then, we have a problem. If you put the two people together, we don't necessarily have to have income from the person with the good credit, but we do have to have the person with the income, their credit on the file. Together, they're stronger than they are separate. So, together, the automated underwriting system, which means I can get an instant answer when I put the file together and put two people on it. If you're on the edge, two borrowers are better than one, because if you think about it, I can hold two people accountable, responsible to make that, repayment of the loan versus just one person. I don't have as many bodies, people to chase if the payment's not being made. Two people will be better off than just one. There is a lot of times where you don't want someone on the loan, not just because of their credit score, but because of their liabilities. There are ways in Texas that we can exclude certain liabilities that were brought on prior to marriage, and that can be case by case. If you had a government loan in Texas, we typically will say, even if your spouse is not on the loan, we have to pull a copy of their credit report and see what community debts that y'all have together. Even though we're not using their credit score, we're not using their income, but we look at household liabilities, and that goes on FHA, VA, USDA. However, if those debts were student loans from way prior to marriage, a lot of times we can get those excluded and not count against the borrower and their qualification, because the borrower ultimately is not going to be held liable by law for debts that were consumed or prior to marriage. Only the ones that were brought together during marriage will be the ones that we can't dance around. And that's only on government loans. So if we do a standard conventional loan, just whoever the borrower is will be the only one that we use liabilities for. If you're a strong enough borrower, and let's say your spouse happens to have some collections or bad debts or something like that, if we go with a conventional loan, we do not have to consider those liabilities against you.